Let's slow this down because what just happened wasn't fundamentals, and it wasn't a headline suddenly changing reality. This was mechanical behavior. This wasn't a vote. It was a margin call disguised as a trade. They responded to constraints. One market became a release valve, the other became a pressure chamber. Gold relieved risk. Silver absorbed it. That asymmetry matters, because it tells you this flow was rule-driven, not belief-driven. When volatility rises and leverage tightens, portfolios don't express opinions, they obey limits. That's why this move arrived fast and felt violent. Not because conviction increased, but because tolerance decreased. The urgency here isn't about price targets or predictions, it's about timing. The market has entered a decision window where small inputs can create outsized reactions. In a minute, I'll show you the single signal that decides whether this resolves into acceleration or reversal. Stay with me, because the discomfort you felt has a very specific cause. So let's strip this down to the raw mechanics without emotion layered on top. The data point is simple. Funds reduced exposure in gold while simultaneously adding roughly 11,400 long contracts in silver. That sounds like a preference shift if you read it like a headline. Mechanically, it isn't. This is about net exposure management, not directional belief. Large funds don't think in terms of liking one metal and disliking another. They think in terms of volatility budgets, margin sensitivity, and how much risk the book is allowed to carry when conditions change. Gold became the release valve because it has deeper liquidity and a smoother volatility profile. You can cut size there with less slippage and less secondary damage. Silver is the opposite, thinner liquidity, higher convexity. Every unit of flow moves the price more. When constraints tighten, flows don't spread evenly. They concentrate where the math allows them to. Silver absorbed the flow not because it was suddenly loved, but because the structure could carry it, at least temporarily. This kind of rebalancing accelerates under volatility constraints. As price moves, margins adjust. As margins adjust, allowable exposure shrinks. That creates time compression. What might normally unfold over weeks gets forced through in hours. That's why this looked abrupt. And it's important to say what this was not. This was not a macro thesis reversal. It wasn't a sudden discovery about inflation or growth. It was rule enforcement inside portfolios. When rules tighten, portfolios don't argue, they comply. This explains what happened. Next, we need to address why it felt so violent, because there's a structural weakness here most people are missing. Now we can talk about why this move felt violent, even if the explanation itself is calm. Violence in price is usually silence in liquidity. When liquidity thins, every order carries more weight than it should. During stress, bids step back, spreads widen, and price has to travel farther to find a counterparty. Forced sellers don't negotiate. They don't wait for good prices or clean structure. They execute because rules demand it, not because conditions are favorable. As selling begins, it runs into stop clusters that were built during quieter periods. Those stops trigger more selling, which forces dealers to hedge dynamically. Dealer hedging feeds back into the move, not as intent, but as obligation. This is how volatility creates more volatility. Rising price movement increases margin requirements. Higher margin requirements force additional reduction in exposure. That reduction adds more flow into already thin markets. The loop tightens. Silver amplifies this effect because its structure is less forgiving. Thinner liquidity means smaller trades move the tape. Higher convexity means changes accelerate quickly. In stress, silver stops behaving like a commodity and starts behaving like a leveraged instrument. Logic doesn't disappear, but it gets outrun. Price moves first. Explanations chase later. The psychological impact is not accidental. The nausea, the urge to act, the fixation on every tick, that's what forced moves create. They're designed to shake out weak positioning and compress time horizons. There's a line where this behavior flips from damage to fuel, and it doesn't announce itself in advance. Next, we need to separate what we actually know from what we're projecting, because confusing the two is how disciplined people get pulled into emotional decisions. Before we go any further, we need to slow the narrative down and separate facts from interpretation, because this is where credibility is either built or lost. Fact: gold exposure was reduced. That is observable. Interpretation: that reduction represents risk relief under tightening conditions, not a declaration that gold is broken or unwanted. Fact: silver longs were added in size. Again, observable. Interpretation: silver absorbed flow because of structural positioning needs, not because certainty suddenly appeared. Size does not equal conviction when constraints are active. Fact: volatility expanded sharply during the transition. You can see it in the tape, the ranges, the speed. Interpretation: rules were in control, not rumors, not emotion, not some hidden headline. When volatility expands, portfolios shift because they must, not because someone changed their mind. This distinction matters, especially in compressed windows like this one. Uncertainty is not a weakness here, it's the honest frame. If conditions change, behavior changes. If margins loosen, pressure eases. If liquidity returns, move slow. None of this guarantees direction. It defines probabilities. Misreading forced behavior as belief leads to the wrong trade at the worst time. Over the next 14 days, the market will keep revealing which interpretations survive contact with new data. Facts anchor us, interpretations keep us flexible. Up to this point, we've been talking about paper behavior, and that's intentional, because paper moves first. But paper and physical operate on different clocks, and during stress, that timing mismatch becomes critical. When funds rebalance, contracts change hands instantly. Physical demand does not. It responds through premiums, inventory movement, and delivery pressure, and those signals arrive with a delay. During volatility, premiums are the first tell. If price drops while premiums hold a rise, that's not contradiction, it's separation. It suggests that selling pressure is financial, not supply-driven. Inventories tell a similar story. Drawdowns that continue despite falling prices imply material leaving the system. Replenishment that stalls tells you replacement metal is harder to source at current terms. Delivery behavior adds another layer. Rising delivery requests or settlement extensions indicate strain that price alone doesn't show. Physical systems don't reprice every second. They absorb shock, then respond in steps. That's why watching only the screen creates confusion. Physical buyers also behave differently under forced paper selling. They don't chase candles, they wait. They step in quietly when liquidity-driven moves push prices into zones that make sense for real use and long-term storage. This doesn't mean price can't go lower. It means demand is conditional, not reactive. Divergence matters more than price alone because it tells you which market is lying. Paper panics first, physical speaks last. One physical metric usually moves before price catches up. Ignore this, and you're trading blind. At this point, it's useful to lay out the paths in front of us, not as predictions, but as conditional scenarios that respond to behavior. Scenario 1 is the breakout. In this case, liquidity slowly returns, price holds above the recent compression zone, and added longs are not immediately punished. Volatility contracts instead of expanding. Pullbacks become shallow. Premiums stabilize or firm. That combination increases the probability that the recent flow becomes fuel rather than friction, allowing price to grind higher without urgency. Scenario 2 is the fake-out. Here, price briefly pushes above key levels, momentum traders pile in, and then liquidity evaporates again. The tape looks strong until it doesn't. Volatility re-expands, open interest drops, and price slips back into the range. This is where late buyers get trapped and confidence erodes. The warning signs are familiar. Rising volume with no follow-through, premiums that fail to confirm, and rallies that require constant pressure just to stand still. Scenario 3 is the most uncomfortable, but structurally common. A washout, then higher. In this path, one more forced flush clears weak positioning. Price undercuts support, headlines turn sour, and conviction is tested. Margins do their final damage. But after that release, selling pressure exhausts itself. Liquidity improves because there's less left to force. If physical metrics remain firm during that process, the odds shift toward recovery rather than continuation. None of these paths is guaranteed. What matters is not which story sounds best, but which behaviors appear. Probabilities shift when volatility contracts or expands, when premiums diverge or confirm, when inventory moves or stalls. Belief doesn't move markets under stress. Response does. Scenarios don't predict, they prepare. Only one of these aligns cleanly with rising premiums and stabilizing liquidity, and the difference will become visible before it becomes obvious. The next section is about how to survive all three without being forced into decisions the market wants you to make under pressure. From here, attention has to narrow to signals you can actually observe, because this window will not stay open long. Premiums come first. If paper price moves while premiums rise, or even stay flat, that suggests stress is being absorbed, not distributed. If premiums collapse alongside price, that's a different message. Inventory is next. Week-over-week changes matter more than headlines. Persistent drawdowns imply metal leaving the system. Sudden replenishment implies sellers found supply willing to part with metal at these levels. Delivery behavior adds texture. Rising delivery volume or quiet settlement delays signal friction beneath the surface. They don't predict direction, but they reveal strain. Margin rules are another pressure point. Any warning, hike or tightening amplifies forced behavior. Even the absence of change matters if volatility stays elevated. Open interest must be read with price, not alone. Rising open interest with stable prices suggests absorption. Falling open interest during sharp moves suggests liquidation. Liquidity depth is the final tell. Watch how price behaves during rallies and dips. Does it travel easily, or does it stall after small size? Easy movement on low volume means thin markets. Difficulty moving despite volume means resistance is building. All of this matters inside a compressed time frame. The next 10 to 14 days are critical because rules, margins, and positioning reset quickly in periods like this. If two of these signals align, The next move won't be subtle. Miss them, and you'll be reacting instead of deciding. Signals whisper before price screams. Before we close this out, it's worth recentering the perspective. Nothing here requires panic, and nothing here rewards complacency. This is a period that favors attention and patience. The market has made its move, shown its structure, and now it's waiting to see who reacts emotionally and who observes behavior. I want to hear from you in the comments, because collective observation matters more than opinion right now. Which signal matters most to you in this window? Premiums, inventory movement, delivery behavior, or margin pressure? And second, when these diverge, which do you trust more in moments like this? Price on the screen or conditions in the physical market? If this style of briefing helps you stay grounded when volatility increases, make sure you're subscribed. Not for predictions, but for preparation. This channel exists to slow the moment down when the market is trying to speed you up. We're not done with this story. If we get another margin adjustment while price stabilizes, that combination changes the tempo quickly. That's when moves accelerate, not because sentiment shifts, but because pressure builds quietly. The market just showed its teeth. Now we watch how it breathes.